Welcome to Explain the Charts. Today is March 24th, 2026, and we are performing a deep dive into BTCUSD. The market is currently reeling from intense geopolitical developments in the Middle East that have directly impacted price action. Headlines today are dominated by the ongoing drama between the US and Iran, which has kept the crypto rally in check. President Donald Trump recently issued a 48-hour ultimatum to Iran regarding the Strait of Hormuz, causing wild swings. Despite the tension, Bitcoin has shown incredible resilience, outperforming gold and stocks during this period of uncertainty. Institutional activity remains a massive driver, with MicroStrategy recently purchasing another $76 million worth of Bitcoin. U.S. spot Bitcoin ETFs have also seen a 4-week inflow streak totaling roughly $2 billion recently. However, we are also seeing some signs of ETF flow stagnation, with recent net outflows of $84 million reported. On the regulatory front, the SEC has declared most crypto assets as not being securities, providing some clarity to the market. Miners are currently facing a profitability squeeze as production costs remain near $88,000 while the spot price hovers around $70,000. This has led many mining firms to pivot toward AI and high-performance computing to diversify their revenue streams. Looking at the long-term one-day chart, we can see the broader trend Bitcoin has followed over the last 2 years. The asset has been in a sustained uptrend since late 2024, but the volatility in 2026 has been particularly sharp. We are now entering a critical technical phase where the $70,000 level is acting as the primary line in the sand. Focusing on the 2026 action on this daily chart, we see the impact of the recent price shocks. Back in early February, Bitcoin hit a low near $60,000 following initial war concerns. The recovery from those lows has been steady, with the price reclaiming the $70,000 psychological level. Notice the heavy resistance we are finding as we approach the $75,000 mark. Every attempt to break above $75,000 has been met with significant profit-taking by short-term holders. In mid-March, Bitcoin actually soared past $75,000 briefly as momentum built, only to be rejected by the Fed's hawkish stance. The Federal Reserve recently held interest rates steady at 3.5 to 3.75%, which contributed to the recent market pause. From a technical perspective, the daily candles show a series of higher lows, which is a bullish signal in the long term. However, the RSI and volume data suggest that spot buying is weakening at these elevated levels. The correlation between Bitcoin and the S&P 500 remains high, which some analysts view as a risk factor for a potential drop. A bearish outlook suggests we could even revisit $46,000 if the 200-week moving average fails to hold support. Conversely, if we sustain support above $70,000, a push toward $80,000 becomes a very plausible scenario. We must watch the daily closes closely to see if we can consolidate above the previous resistance turn support. The daily chart reflects a market that is waiting for a clear catalyst to choose its next major direction. For now, the bulls are in control of the trend, but the bears are defending the $76,000 region with conviction. Switching to the 15-minute chart, we can see the intraday reaction to the latest news cycle from March 18th to now. On Sunday, March 22nd, Bitcoin dropped nearly $2,000 in under 30 minutes following Trump's ultimatum to Iran. This triggered a liquidation cascade of approximately $232 million in the derivatives market. In this view, you can see the sharp red candle that took us from $70,000 down to the $68,000 support level. However, as talks became more productive, the market saw a rapid V-shaped recovery as shown here. By March 23rd, the price surged back above $71,000 as short positions were squeezed. This 15-minute data shows a clear battle for control between $68,000 and $72,000. Notice the high volume spikes during the recovery phase, indicating strong institutional buy-the-dip behavior. Whale wallets were reported to be buying the dip at a record pace as exchange reserves hit a 7-year low. The volatility seen here is a direct reflection of the market pricing in war risk versus de-escalation. Short-term traders should look for entries near the 68,500 support zone if volatility returns. The immediate resistance is now sitting at 71,800, which capped the latest rally on the 23rd. Watching these 15-minute intervals helps us see how the market reacts to every tweet and news headline. We see a lot of noise, but the underlying structure remains remarkably resilient despite the geopolitical pressure. This is a classic risk-off environment where Bitcoin dominance is rising as capital moves from altcoins into BTC. To understand the context of this month better, let's look at the 1-hour chart from early March. During the period between March 3rd and March 6th, we saw Bitcoin struggling to stay above 67,000. This was when the initial threats regarding the Strait of Hormuz first surfaced. The chart shows a period of heavy consolidation followed by a breakdown below 66,500 on March 3rd. However, the support at 66,000 held firm, acting as a springboard for the eventual rally to 74,000 later in the month. We can see a golden cross pattern forming on the larger timeframes during this consolidation phase. The negative funding rate seen in early March suggested a crowded short environment, which eventually fueled the upward move. When the market is overly bearish, as it was then, a short squeeze is always a lurking possibility. The price action during these few days established the 68,000 level as a very strong pivot point for the rest of the month. Looking at the hourly candles, the VWAP stayed consistently below the price during the recovery, a bullish sign. This historical data from just a few weeks ago confirms that Bitcoin uses these dips to build liquidity. It serves as a reminder that macro events often create temporary volatility within a larger structural uptrend. Back on the daily chart, let's recap the critical price levels you need to keep on your radar. Immediate support is at $70,000, with a secondary, stronger support floor at 68,000. If the geopolitical situation worsens, we must look at 63,000 as the next major zone where buyers likely step in. On the upside, the first major hurdle is 71,800, followed by the heavy psychological resistance at 75,000. A clean break and daily close above 76,000 would likely signal a run toward the $80,000 mark. In my unbiased prediction, there is a 60% likelihood of continued consolidation between 69,000 and 73,000 over the next week. This likelihood increases if no further military actions occur and the oil price stabilizes. There is a 40% chance of a breakdown to 63,000 if the Fed remains hawkish or if the ultimatum results in actual strikes. Look for Bitcoin dominance to stay high as it remains a preferred safe haven over altcoins right now. Institutional demand is the backbone of this market, and any further buys from firms like MicroStrategy will reinforce the bullish case. Keep an eye on ETF net flow data, as it is the most reliable indicator of institutional sentiment at the moment. Thank you for watching Explain the Charts, and make sure to subscribe for more in-depth data analysis. Please remember that this video is for educational purposes only and is not financial advice. Markets are risky, so always do your own research before making any investment or trading decisions.